Yeah. Yes, good evening all. I hope I'm audible, I'm visible. Yeah,
Yes.
perfect. Yeah, so good evening all, and would like to welcome you all of our esteemed partners and clients. Thank you for actually joining us for this very insightful webinar today. Just to introduce myself, I am Rahul Sejwal, your host for this particular session today. I have about 17 years of experience in terms of mutual funds, PMS, and AIF industry itself. Currently leading the zone for MK Investment Managers. For those who are not fully acquainted with MK, just maybe I'll brief a bit overview on MK. So MK has been in this financial industry for more than 27 years. We are a listed entity on both BSE and NSE under the name MK Global Financial Services. We have about four major businesses that we are into. One is MK Share Broking, wherein we are renowned into our strength in our institutional equities. We have MK Investment Banking, wherein we play a pivotal role when it comes to lead banking on some of the IPO managers. Third business is MK Investment Managers, which me and here Kashyap represent today. We have been into existence for more than 12 years now. One of the longest running portfolios, Capital Builder, has a track record of about 12 years and has compounded about close to 17% kind of a CAGR in the last 12 years. And fourth one business is the MK Wealth, wherein our distribution arm, basically it's our distribution arm of MK. It operates just like any other distributor in our network. Today's discussion actually revolves around an increasingly pertinent topic about manufacturing, and this sector has actually garnered a lot of significant interest, and being a focal point on today's discussion. At MK, we actually identified this trend earlier, and we have actually launched a PMS portfolio dedicated to this manufacturing as a trend, wherein this portfolio, as we speak on 13th of June, has completed about 2 years and has delivered about 40% of exceptional CAGR returns in the last 2 years. Just to put in a numbers perspective, a crore invested about the start of this portfolio today would be handling somewhere close to about 1.9 crore as an investment value. Now, without further ado, I would like to also introduce Mr. Kashyap Zaveri. Kashyap brings in about more than 18 years of experience on the table, with 14 years spent with MK itself. His journey began in MK Institutional Equities and has transitioned into a pivotal role at MK Investment Managers for the past 7 years. As the head of research as well, he oversees the NV portfolio. Kashyap also expertises, extend into, beyond manufacturing and services sector, into banking and economics as well, providing invaluable insight into our investment strategies. With that, I would like to thank you all once again for joining us today. We look forward on an enriching discussion today. And in case of any questions, please feel free to ask and put it into the Q&A box. One by one, we will obviously take all the questions going ahead. With that, Kashyap, I'll hand this over to you.
Thank you so much, Rahul. Let me just give you some background about or some introduction about me. Also, I've been associated with MK Group now since almost about 18 years. Initially, I started my journey on the institutional equity side, where I used to service all the CIOs and mutual and fund managers of the mutual fund industry as well as insurance industry. So right from Mr. Prashant Jain to Mr. Naren, within the mutual fund industry and who's who in the insurance industry. I used to do, I used to service those fund managers at that point of time. Somewhere around 2018-19, I did a transition to MK Investment Managers. Initially, my role was as an analyst, and then since last about 3.5 years, I've been handling some of the funds here at MK as a lead fund manager. NV being one strategy which was started from scratch and scaled up to where it is today. Like Rahul said, initially had somebody invested 1 CR with us in June 2022. Today it will be worth roughly about 1.9 CR. But let me go a step back here further. We actually started or are dabbling with the manufacturing as a strategy. Started somewhere around March 2021. Initially, we launched this product actually on the small case platform. We ran that for about 15 months. Then we migrated it to PMS platform. Now it's been there for about 2 years. Somebody who had been with us on small case platform as well as on the PMS platform put together, that 1 CR would be now worth almost about 2.6, 2.5 or 2.55 CR at this point of time. So almost about 150% higher than where it was. To just add a bit more about our firm, Mr. Prakash Kacholia and Mr. Krishnumar Karma are the two promoters. We have been in this business now for almost about this would be our 30th year in this business. So almost 3 decades of experience in the overall equity markets, and almost about 12 or 13-year experience now in managing client money as such. We overall also have an experience about not only raising money from the clients, but returning money back to the clients, where we redeemed our AIF 1, 2, 3, and 4. In totality, we have returned almost about 700 crores worth of funds back to the clients. And much before time when the funds were about to close, we returned money almost about 6 months ahead of the scheduled closure of the fund. So, in terms of client trust, now that's about 700 crores worth of money returned back also to the clients, and much before time. Rahul has already spoken about our senior management team. So Manish, Sachin, and me are the fund part of the fund management team. But I would also like to highlight here is that we have our own dedicated research of 4 more people. Whichever companies that we invest in, we do our own in-house research on that particular company before we invest in that company. Besides that, we also have a backup from our parent company, Emkay Global Financial Services, where there is an analyst team of another about 25 or 30 odd people, and they also provide some sort of research services to us as and when needed. I think about 3 years ago in March 2021, this is the idea that was still in a very nascent stage. Not many probably people were talking about how India could be manufacturing powerhouse to the world. But I think in 2021, this is something that we thought was this was just around the corner, that India would become a manufacturing powerhouse. It's an idea whose time has come, and probably there will be no stopping us for next about 10-20 years in terms of where manufacturing will go. And I think our confidence came from the fact that there were a lot of global giants who were talking about how India can be their manufacturing base, whether it is in terms of electricity generation, power distribution, equipment manufacturing companies, whether there were companies in the manufacturing of aircrafts, whether there were companies in the manufacturing of chemicals, whether there were companies in the manufacturing of electronics and electrical equipment. I think most of these people are global giants were talking about making India their one of the world's largest factory. And all these were, looking at setting up plant in India for its supplies to any other country, which is ex-China. And I think that's where we got a lot of confidence. And, it's pretty much visible also in the fact that if you look at last about 3 years now, Nifty India Manufacturing Index, which was one of the worst performing index between 2015 to 19. And mind well, these 4 years were, sort of affected by first demonetization, then by GST, then consequently in 2020 by COVID. In between, what we also saw was that the inflation and growth globally were extremely low, and because of which the manufacturing index was one of the worst performing index. If you look at from March 2021, when we started our strategy on manufacturing on small case platform, Nifty India Manufacturing Index has not only outperformed the broader indices like Nifty 50 or Nifty 500, but many other sectoral indices also like Nifty Financial Services and Nifty IT. I think, what we believe is that India's rise as a manufacturing powerhouse to the world, we are probably just at the start point of that whole cycle. If I were to draw an analogy, I think this is, I'm sort of, going a bit far ahead in future and probably trying to, commit a bit more than what we could really achieve. But I think if I were to draw an analogy here, I think what we are going to do over next about 15 to 20 years in manufacturing is going to be pretty much similar to what China also did in manufacturing for past 30-40 years. I think if we continue with the right policies and the right kind of product selection in manufacturing, over next, let's say 15 to 20 years in many of these products, India is going to be world's largest supplier, in some of these products as we go forward. Not to, sort of forget that, not only the world, we have about 150 crore population in India. As this population grow, sort of migrates in terms of its aspirations, in terms of its own income, tiers, this population is also going to ask for many of these products for consumption. And that's where, I think manufacturing as a powerhouse will continue to emerge. When we did this strategy in 2020-21, there were a couple of things that we saw, both or rather not both, but across the ecosystem, whether it was the manufacturer, whether it was the consumer, or whether it was the government. We saw that there were, structural changes happening in all three of these parts of the ecosystem, and which was, very, very conducive for the Indian manufacturing sector to make a very strong comeback. What we saw was that the return on capital employed for the manufacturing sector was improving. If you look at the capacity utilization of the manufacturing sector as a whole was improving. What we saw was that when these returns were moving up, the manufacturers were actually cleaning up their balance sheets also. They were saving a lot of cash, and consequently they were paying back the debt. In fact, what we saw was that debt to equity ratio of some of the most indebted sectors, which is whether it is iron and steel and ferrous metals, the debt to equity ratio was coming down. And not only what we saw was that, within manufacturing sector, when we look at about 13, 14 odd industries, these changes were visible not only in one or two of them, these changes were visible in all 13 or 14 odd industries, which were part of the manufacturing as an, as an umbrella, whether it was FMCG or automobile, which was consumer facing industries, or whether it was capital goods, or let's say cement and some of the other categories where it was B2B in nature. We could clearly see that return ratios were improving, cash conversion cycles were improving, and debt to equity ratio of the whole sector was declining. What we also saw was that during the same period when people were, or rather corporates were saving cash, they were also getting quite aggressive in terms of capex. If you look at the spends on plant, property, and equipment, which is normally the capex that corporates do, every year after year, that number was rising. In fact, if you look at the H2 of FY24, cumulatively, BSE 500 companies involved in manufacturing have ended up spending almost about 3,20,000 crores on capex. And this is by far the highest number of amount that the corporates within BSE 500 index have spent on plant and machinery. So in terms of manufacturer, what we could clearly see was improvement in return ratios, them paying off debt, the most of these corporates actually coming back in terms of very aggressive capex. And alongside, what we could also see was that, government was doing its own significant amount of reforms, whether it was in terms of budgeted spending on infrastructure, roads, railways, ports, irrigation, sanitation, whether it was water transport, schemes like Nal Se Jal, Jal Shakti Ministry, which was separately established, some of these capex that they were doing. What we could also see was that they were tinkering with the corporate tax rates. The peak corporate tax rate, which used to be 35% plus, they brought it down to about 25% effective tax rate. Today, if you were to put a new capacity in a new company, the effective tax rate applicable to a new company and new capex is only 15%. Clearly, what we could see was that the government capex, which used to range anywhere between less than about 2.5% of GDP, suddenly last 3 years, we have seen that going up to about 5.5 to 5.6% of GDP. The other thing that the government did during the same period was coming out with performance-linked incentives. If you look at India's history in terms of what we have done for manufacturing in past, some of these sectors used to have incentive policies which were linked to capex. You do 100 rupees of capex, you get 5 rupees of incentives, no questions asked. Today, what you're saying is that if you're doing 100 rupees of capex, I will pay you only 5 rupees of subsidiary only and only if you are producing out of that 100 rupees, 105 rupees of new production. Unless you get me that production, I will not give you that incentives. which clearly means that, incrementally, manufacturing as a part of GDP, which came down from, let's say, about 34-35% at the peak in 2002, which came down to about less than 20% today. Clearly, what we are going to see is that number going past about 25% in next about 4-5 years. I think if we do this right, and all the industries which are related to some of these industries, for example, in case of, let's say, EV batteries, you need a lot of chemicals. So if you establish new chemical industries in India, for many of these, you require a lot of ABS plastic. So if you establish ABS plastic industry in India, what we are going to see is manufacturing as a percentage of GDP going up significantly. We have already started seeing some trends in terms of what positives could come from PLI. So we have clearly seen that FDI flows in some of these industries has gone up. In some of these industries, our reliance on imports and our aggressive exports, a lot of these things have seen improvement. Clearly, what we see is that pharma, auto equipment, chemical entities, electronics, the amount of FDIs that used to come to some of these sectors has clearly gone up post the announcement of PLI scheme. What we are also seeing in terms of consumer is that for the first time in last probably about 8 or 9 years, we have seen salaries and wages bill for BSE 500 index going up. What we are clearly seeing is that some of the discretionary spends, whether it is in terms of vehicle sales, whether it is in terms of health, whether it is in terms of auto ancillary, whether it is in terms of affordable housing, whether it is in terms of building materials, which might include, let's say, plywood, laminates or PVC pipes. Some of these, spends have grown much faster than overall consumption expenditure. And I think as we go forward and the income tiers, as they move from, let's say, lower, part of the pyramid to the upper part of the pyramid, we do see that, some of these products will be aggressively consumed in India, whether it is in terms of smaller cars, whether it is in terms of motorbikes, whether it is in terms of housing, whether it is consumer durables. Some of these, products which are today, within the, reach of much less people at this point of time, over a bit of next 5 to 6 years, I think the consumption of some of these, products will expand materially. I think as we produce more for the Indians who are going to ask for some of these, products more and more, and as we produce for the world as a manufacturing powerhouse to supply to the world, there are 4 key themes in which I think there is a significant amount of money which we can make. Whether it is, investing in companies which are involved in manufacturing for consumption in India, whether there are companies which are involved in manufacturing of products which we are going to export to the world, whether it is companies which are going to produce products which we are today importing in India, but eventually we are going to manufacture in India. And last but not the least, there are services which are affiliated to some of these manufacturing services, which includes transportation. What we are never going to invest in is basically BFSI, IT, and some of the other services space. We built this strategy originally and it continues to run. So it's going to be a flexi cap strategy where we are going to look at market cap across the board. We are also flexible about, the sizing of the bets that we do on each and individual stocks, depending on confidence that we have in that particular company about achieving its goals. We run a fairly focused portfolio of about 15 to 25 stocks. Number of the stocks in the portfolio, like I said, are going to be limited to about 15 to 25 odd. How earlier said, we were able to identify this thematic or rather trend much earlier. We launched this on a small case platform. That India manufacturing small case on that particular platform delivered returns of roughly about 37% over a period of about 15 months, and outperforming the benchmark by about 16 percentage point. Down the line, we brought it to the PMS platform, where we generated a TWRR of about 35% since inception. That's almost about 8% outperformance versus the benchmark, which is BSE 500 TRI. Largely when we do and how we have been able to achieve this, despite the fact that our focus has been or rather the portfolios that we build have been very focused ones, limited to just about 22 odd stocks. what we basically do is that when we build that focused portfolio, we build this portfolio based on the equal platform or equal framework. Basically, it's an MK quality framework. What we are trying to do here is that when we are investing in just about 2022 odd stocks, let's at least make sure that out of that 22 odd stocks, we don't investing anything which tomorrow down the line, probably we find that, the promoter is a crooked one, and because of which we had to write down our investments. So far as we make sure that we don't commit any mistakes on the promoter side and invest in the right promoter or right company, I think it's very, it gets the job much easier to do. And how do we eliminate that mistake of, banking on the wrong promoter? And when I say wrong promoter, examples could be like 1% beverages, it could be Yes Bank, it could be, for that matter, a company like Wakarangi, it could be PC Jewelers. Some of these names where, one would have invested and had to write down the particular investment because the promoter and our interests were not aligned. The promoter probably wanted to make money for himself and probably never wanted to share that wealth with the minority shareholders. So how do we make sure of that? The equal model is basically a 100 marks question paper, which is broken up into 5 different sections. For example, when you used to give our exams in schools or colleges, in a 100 marks question paper, we used to have, probably a long answer, a short answer, fill in the blanks, true or false, and so on and so forth. So there are 5 sections in this question paper. Within each of this section, we used to have 5 to 7 different other questions, right? So within this 5 to 7 sections, we have, within this 5 sections, we have about 7 to 8 odd questions within each of these sections. For example, when I look at management integrity, there are 9 key questions that we ask about the promoter. Whether the promoter holding in that particular company is 0% to 75%. If it's 75%, then I think more often than not, his and our interest will be aligned in terms of wealth creation, because this is where his maximum wealth is placed in this particular company. Whether the promoter has pledged any of his stock. It could be 0%, it could be 5%, 10%, 20%, 30%, 50%. Depending on how much of the stock is pledged with the financial companies, we would assign some marks to that promoter. There are ways in which a promoter can take money out of the company for himself and not leave that money for the minority shareholders, which is to take very high salary. It could be to take very high royalty. It could be in terms of interrelated party transactions. Any of this, very high number raises a red flag. So when you, and there are, other sections like, for example, wealth distribution, where we say that if the company has got a fairly long history of dividend distribution, we will give you higher marks. If the company has, or the promoter has invested the company's money into a business which is completely non-related, we will take a very negative note of that. For example, Satyam Computers investing into Mitas Infra is a clear negative for us according to equal model. And once you total up these 5 sections, you arrive at a particular score. Again, before we arrive at the score, there are 6 no-go areas or red flags. For any company where promoter pledging is more than 70%, we will never invest in that company. If there is a debt restructuring in the past, we will never invest in that company. Debt to equity ratio of more than 2.5x, we will never invest in that company. If the investments in non-related businesses are 50% or more of the net worth, we will never invest in that company. When we do this, what we are basically doing is to eliminate any mistake on relying on the wrong promoter. And also what we do is to use this equal model in terms of our purchase and selling price discipline. So let's say a company's equal score is 72% and it's a small cap 1 company. So minimum return that I have to make for that company investment is about base 4, which is, in a simplistic term, it will be 4 times of what the risk-free rate of return. So let's say the 10-year GSEC is about 7%. I will not invest in a small cap 1 company with a base score of about 72% unless I am making about 28% compounded annual return in that investment over a period of next 5 years or so. Moment I see that this company is not going to make more than 25% kind of compounded annual growth rate return for me, I will exit also that company. So we are taking care of the purchase price discipline here and selling price discipline here by taking into account the equal score and the size of the company in terms of market cap. So that's how we have built this portfolio. And until now, in last about 13 years of history, fingers crossed, we have had never written down any investment because the promoter, was responsible for that company going belly up. We might have had some losses in the past in some of the companies that we have invested in, part and parcel of the game, but that would be related to whether there are economic reasons which have turned bad, or let's say the growth ratios of the company have been lower than what we had anticipated. But never in our life we had an investment like Vakarangi, PC Jewelers, Satyam, Mitas, Yes Bank, or Manpasand Beverages, which we had to write down because the promoter was a crooked guy. So I think that's broadly from my side. I think over a period of next about 10 to 15 years, a significant amount of money to be made from manufacturing. I think any client who wants to take advantage of that rise of India as a manufacturing powerhouse needs to do in a very focused way. You have to have a portfolio of only 20 to 25 companies, and probably not a huge tail of 50-55 companies where you invest in 55 companies and each of them will not have probably a weight of more than 0.5% or even less. You need to have a portfolio which is very distinct in nature, not a run-of-the-mill portfolio where weight of top 10 companies will be found in any other mutual fund scheme. I think that's what one needs to avoid at any cost. You have to bank on the companies which you believe are small cap or mid cap today. And in this whole run of manufacturing over a period of next 10 to 15 years will become from small to mid and mid to large. I think that's the whole, journey that we want to achieve this with this NV portfolio, MK New Vitalized India strategy, which is focused solely on the manufacturing. It will not have any companies which are involved in services, whether it is BFSI, despite the fact that 55 to 60% of our BA bank portfolio is related to either MSME financing or manufacturing financing, but it will still not be part of this portfolio. So I think it's a very focused portfolio that we are running here, based on this equal framework. We'll make sure that the client's money is not, is not put into any unscrupulous promoter, and a very focused portfolio that we will try to build over here. I think that's it from my side. Rahul, if you want to add something or you want to open for Q&A, back to you.
Yeah, thanks, Kashyap. I think that was pretty brief. Good to know the segment, why manufacturing should do good, and your insights on that particular were excellent. With this, I think we open the floor for questions. Please type in your questions in the Q&A box. I'll try and ask them each one as soon as possible, as soon as I get them. Kashyap, there are a couple of questions which I have been, on the ground, and some of the clients have been asking. So one is being where the market is, right? Being the small and mid cap, we have seen the rally that has happened in the last couple of years. And considering this portfolio might have little more skewness towards mid and small space, because I guess the opportunity lies in that space. Would you still believe that it would be a decent risk portfolio, or is that the game that we are trying to play and say that next 5 years, 7 years, this is what the play should be for you to make more money?
Sir, thank you, Rahul, for that question. I think what matters the most here is that this is going to be a trend for next probably anywhere between 10 to 15, or maybe if we see the stability on the political side, this is going to be at least 15 to 20 year kind of run that we will have here. So your time in the market is going to be more important than you timing the market. That's the first point. So if it's going to be a very long-term money-making trend, I think you have to be in that trend rather than timing when to enter that trend. Having said that, there is no denying that the valuations in the market are slightly on the higher side in bits and pockets. You can't have a scenario where a B2B company quoting at similar valuations as a B2C FMCG company. I think that's in bits of pockets that's happening. Having said that, what's my job? My job is clearly to find opportunities where the growth turnaround is happening, and because of probably some bit of problems in past, the stocks or those companies were available at cheaper valuations, or let's say cheaper to reasonable valuations. Let's put it that way. That's what my job is, right? So I think we are going to continue to do our job, which is to find growth turnaround stories which according to equal framework fit into that buying and selling discipline. Eventually, when we find that pricing or valuation dichotomy or valuation distortion, we will not shy away from also selling the stocks, and we have done that in past. And that's how we will take care of this whole dilemma of how to how to fight this kind of steroid driven markets to some extent, if I were to use those words. So I think we'll continue to do that job on behalf of our clients. Yeah, I think that's broadly what I would say, that yes, time in the market today in this particular trend, which is going to be next 10, 15, 20-year kind of a phenomenon, is more important than timing the market. Having said that, how I will take care of your time in the market is by probably investing in the companies at the right price, where we see the growth turnaround happening and where valuations are in our favor.
Got it. We have a question from Mr. Bhagirath. He is mentioning, or rather asking, that a bit of more information on how do we do our research, and what kind of capabilities are there in terms of our research team, because that's the crux of any investment house.
Right. So this is basically the philosophy that we follow. We call it our hexagon of investment philosophy. Basically, any investment that we do it with a perspective of being there at least for next 3 to 5 years, and by compounding the returns over there. How do we do that? How do we keep our churn rates lower? And you can pick up any of our portfolio, even in case of NV, which has been there now for about 2 years on PMS platform, about 1.5 years prior to that on the small case platform. Our churn ratio is not more than 10% on any particular year. How do we do that? Is based on the conviction that we have in that particular name. We basically focus on what could be the absolute return over a period of next about 3 to 5 years based on the equal score of that particular company and its market cap. And the way we do it is by doing our own homework, where we have an analyst team of 4 more people who support us. What we do is obviously the simple things that a lot of people do, which is to meet companies, look at their financials. But what we also do alongside is to meet their competitors, to meet their customers and vendors, and to also do a lot of data churning on unlisted space. For example, not in this portfolio, but let's say in any other portfolio, we had invested in Inox Leisure, which is into movie exhibition space. Not only did we study Inox Leisure and PVR, but we also did unlisted companies like Cinepolis and Mirage Cinemas. Not only that, we also did our homework on UFO Movies, which is a company which is involved in just simply streaming of the movies to single screen, right? So we did all that. So we do that 360-degree kind of research, and we do everything in-house. These are the 4 guys who support us in terms of research, and they do everything from meeting the company to the competitor to the unlisted space to vendors to suppliers and customers, everything. And then we build a focused portfolio based on that whole research of about 20-22 companies. And last but not the least, even when we do all this, we make sure that there is no betting on the wrong promoter, at least. Out of 22 stocks, even if I have to, let's say, for example, there are 2 companies which are not fitting the equal framework, and still I invest in them and they go belly up. At least about 10-12% of my portfolio will generate actually 0 returns. It will in fact it will create a negative return, right? And then I have to make up for that negative return from the residual 18 stocks. It's very difficult to do that. So the right at the beginning, when you eliminate this kind of mistakes, half the job is done. right? So that's the amount of money that we spent on, amount of time that we spend on the research. And when we do the financial studies also, we never look at growth rates. That, the sales has grown by about, let's say 35-40% over last 3 years. The profits have doubled over last 3 years. But let's say profits have doubled over last 3 years, but the company has generated zero cash flows. What do you do with that kind of profit, right? So what we look
Right.
at, we look at gross margins, we look at EBITDA margins, we look at PAT margins, we look at how much of PAT margins have been converted into cash, what is the return on capital employed, what is the ROE, and how does that compare with the cost of capital of the company. We never look at growth in the initial part of our research. The growth yield will be a outcome of how much of returns the company is generating on its business, on its assets, and how much of cash it is generating on those assets, which can be redeployed into future capex. And that will take care of the fact that earnings will flow in at some point of time. My stories or my companies might be delayed by a quarter or two in terms of delivering because of exogenous factors, but I will never have to write down any company or any investment because mine and promoters' interests were not aligned.
Noted. I think nicely answered. That was good. To that question itself, one thing that has been questioned is that you rightly pointed out about the commonality between a lot of mutual fund portfolios, right? And what is the differentiation that we are bringing in on this particular PMS, right? So maybe one example that you want to cite off, which is certainly not a common stock in on the mutual fund or even a PMS space, if you want to mention that.
So first thing first, in our portfolio, more likely than not, if I have a portfolio of 20-22 companies, each player for himself. Sizing of the bets at the initial stage will be more or less in the equal proportion. Eventually, I may let it run beyond a certain point because then you gain as you study the company or as you be in that investment for more and longer period of time. Obviously, your confidence in a particular company may go up eventually or may go down depending on the way the promoter is visions are getting materialized. But each player for himself. We will never run a portfolio where top 10 stocks will have let's say 70-80% of the weight, and the residual 12 will have probably less than 20% or less than 25% kind of a weight. We will never have that kind of portfolio. If you look at mutual fund portfolio, even within the manufacturing as a space, top 10 stocks would be more or less similar to what they hold in any other scheme, except for, let's say, BFSI, where you might have, let's say, HDFC Bank and ICICI Bank. But it will still be run in the same fashion, which will be hugging the index in terms of portfolio weights, which will be hugging the index in terms of stock weights, at least for the top 10 or top 15 names. If you look at our portfolio, 80% or 75% of the portfolio is something that will be very unique to the client. I think I can bet on it. Client will not have those kind of names in the portfolio, but not to say that those are the companies which people are not investing because they are not finding them good. We have run each of these companies through equal. Each of this promoter we can stick our neck out and bets that these are the promoters who will eventually make their small companies to mid cap or their cap companies to large cap. I think that's what we look at when we invest in a particular name. If you look at most of the mutual fund portfolio, 60% of the portfolio will be actually large cap. Now, how do I make money in a large cap portfolio when the stories are already discovered? They are already there, and you can bet on those stocks by investing in any other mutual fund scheme also. What we are trying to do here is a focus portfolio, fairly unique portfolio, and the promoters which one can bank on without blinking an eye.
Yeah, so if you could just maybe give one example on the portfolio.
Sure. So if you look at the portfolio, some of these names probably you will not find any research on. You will not find any sell side guys having even research on these names. And you will not probably find them to be part of many even PMS portfolios for that matter. For example, Elecon Engineering, probably in the street, we were the first one to discover that story about 2.5 years ago or 2 years ago. Company into manufacturing of speed reducing gears, which are used in any capex. Eventually, the Capex story also played out, and Ilacon Engineering also played out really well. CCL Products, which is into manufacturing of instant coffee. Not many people would have even heard of that particular name. But we could clearly identify that globally, in terms of coffee consumption, which is not a very fast growing business, this is one company which will take over market share from all the global players by leaps and bounds. And that is something which has happened over last about 2.5 years. Not many people would have, in fact, there are in both these companies, there are only probably 2 or 3 brokerage houses who have written a report. We have invested in a company called Igarashi Motors, which is into manufacturing of actuator motors, which you use in, normal automobile. When you, sort of pull down or pull up windows, you need a motor which is used there. Today, in many of these vehicles, now you see the trunk also getting opened automatically, right? You press a button and the trunk gets opened. You need a motor for that. And today, that particular company has got 80% market share in global actuation motor manufacturing. Not many people would have, in fact, heard of that. There is not even a single broker report, which is available on Igarashi Motors. That's the company that we have invested in, because I think as you go forward, people will look at more and more luxury in the car. They will want to do less and less of, this functionality themselves. You press a button and things happen. And when you want to do that, you need an actuation motor, right? And they are the manufacturers of that motor. So I think that's what we have invested in. I can give you another example over here, where we are very unique in terms of placement. There is a company called CI Automotive. They are into manufacturing of auto component parts across, whether it is forging, whether it is casting, whether it is stamping, any technology you name about. And we could clearly see that, and here this was a case of trend changing. We could clearly see that in past, these guys were investing in a lot of acquisitions. And if you look at the history of Indian corporate, global acquisitions have not turned out great for any of them. You take an example of Tata, which is like best of the best or largest group in India. They've also failed. You look at company like Havells, which has done phenomenal job in the domestic market. They failed. Here is a company which is into small cap space and which is on acquisition spree. The moment we realize that now they have understood their mistake and the capital allocation is going to be a more rational job from here on, the stock was available at one of the cheapest valuations across any auto ancillary. We invested in that company. I can give you another classic example. We have recently invested in a company called Hindustan Foods, and how our differentiated approach has worked here. Today, you have all these FMCG companies which are available at 60, 80, 90p. Here you have a company which is an outsourcing guys to this same FMCG companies. His fortunes are linked to India's FMCG. Last 3 years, if you recall, India's FMCG companies have not seen a very decent volume growth. In fact, because of which Hindustan Foods also was not doing very well. Today, what you are seeing is that last 2 quarters, most of these FMCG companies are now saying that rural is turning around, and they are now very confident of volume growth happening. So obviously that will also have a positive impact on Hindustan Foods. Another thing that this company is doing is that when you're in outsourcing business, you can actually manufacture anything and everything. Today, you are manufacturing soap, shampoo, and toothpaste, but there is nothing stopping you from manufacturing an ointment which is sold, or a cosmetic which is sold on OTC, a chemist shop, right? So you can manufacture Soframycin, you can manufacture a Lakme lipstick, you can manufacture a tablet like a Cofsil or Strepsils, which can be sold on OTC platform. You don't need a US FDA license for that. You can easily manufacture those. What you can also do, and now they are doing now, is that India has got a 15,000 crore sports shoes market, or what you call sneakers market. They are now getting into manufacturing of sports shoes, right? So the categories can be multiple. It can be horizontally expanding on every category. And for last about 3 years, the stock has done nothing. I mean, it's where it was about 3 years ago. And we found that opportunity and we invested in. Not even a single research report on HFL. Not even probably none of the PMS or AS or mutual funds would be having that stock in the portfolio, something which is very unique to us. And not to say that it's there only because of its uniqueness, right? We invested in this company because we saw that the growth will make a turnaround and it's available at the right valuations. Earlier, somebody asked us a question about, how do we do our research also? Before we invested in this company, we also attended some of the exhibitions which were based on FMCG outsourcing in this country. And we met at least about 15-20 companies in that exhibition just to understand, where the trend is going.
Got it. Got it. So pure bottom-up play, I think in-house research. Amazing.
Right.
Thanks, Kashyap. I think the examples that you mentioned were actually very, very unique. Friends, if you have any further questions, please drop it into the Q&A box. As of now, I'll just give you a couple of minutes. If you have any questions, please drop it in the Q&A box. Kashyap, I don't think there are any further questions. Even if you have, friends, more questions, please let us know. We'll get connected on that and maybe bring in Kashyap's view also onto that part. With that, I think I'll thank you, Kashyap, for your valuable time here and amazing inputs on the manufacturing as a segment. Thanks a lot. Thanks a lot,
Thank you so
friends,
much.
for joining us. See you soon.
Thank you. Thank you, everyone.
Thanks.